I'm Charlotte McLeod with investingnews.com, and here today with me is Don Hansen. He's a private investor who's been investing in gold and silver mining stocks for the last 21 years. Thank you so much for joining me. Great to see you as always.
Oh, me too.
Really good to be speaking with you. And just to add some context for our viewers, this is our fourth interview that we're doing on your analysis process for gold and silver mining stocks. So I do recommend that people go back and watch those other three if they haven't seen them already. I'll make sure to link them in the video description. And now for today, I hope that we could start by getting some definitions of some of the terms that we're going to be going over. One of the things we're going to be referring to is three types of engineering studies, and those are the preliminary economic assessment, pre-feasibility study, and bankable feasibility study. So could you go over those definitions first?
Yes, I can. And in general, what I'm hoping to do today is to provide investors with the various factors that I think they should evaluate when deciding which mining stocks to own. And so that's my intention in trying to help them do that. And in terms of the engineering studies, these studies have specific criteria that the Canadian government establishes for them, and their various stages then of that evaluate the deposit, the project, in terms of whether it can become a mine or not. The very first one, called the preliminary economic assessment, which obviously is the first one that explorers will be developing when they think they have enough of the right kind of deposit in gold or silver that they think that it can work. And so then they pay an engineering firm, and the money would usually cost a few $1 million to actually come up with this analysis. And so that then investors can get a sense for whether or not this project actually has real potential or not. And so we'll talk about that as we get into the various stages after that. The next one is the one that the developers do, and it's called the pre-feasibility study, PFS. And all that one is just more detail, where the engineering study explores more things, and the confidence level of the information about the deposit in terms of whether what probability it really has what they think they're going to have. And that's where we get into the confidence criteria that I'll mention in a moment. And then the third one is so-called bankable feasibility study, and that has yet even more detail. And so investors and everybody has even greater confidence that they really have the possibility of a successful gold mine. It's called bankable because you have to have one of those if you're going to borrow money from somebody, particularly banks, and they want to have less risk. So you're de-risking the process as you go through these three stages. And the other thing that is involved with that is the so-called confidence criteria. That is a exploration company or developer or whatever can say, well, I have such a grade of gold at so many depth and all this other. But what they're really looking at for the initial one is a one that's called the inferred resource. And basically what that refers to is the spacing of, for example, of the drill holes. Hypothetically, for example, if you had drill holes every 100 meters, and then another one in the north and south, another 100 meters, there isn't a rigid number. But then the thing is that when you went to the pre-feasibility study, then the spacing would be maybe 50 meters. So you see you're getting it denser, and for the bankable feasibility study, even more detailed, so that there's a better idea of what's actually in between the various drill holes. Well, you know, if it's the closer they get, the greater confidence you have that, okay, they really have what they think they have. And so that's the sequence. And so the sequence then is inferred, And then measured and indicated is the middle one. And then proven and probable is the third one and most confident one. And so the inferred would be what would be the basis for the PEA, or preliminary economic analysis. And then the middle one, the pre-feasibility study, would be based on the measured and indicated grade then for the ore deposit. And the feasibility study, the bankable feasibility study, is for the proven and probable. And so that's how they fit in the sequence of development. So, and the investors are going to see these terms a lot. So it's really important that they understand what they mean and how they fit in this process of going from basically a moose pasture to a gold mine.
Yeah, those are definitely going to be some of our key terms today. I think you explained it very well, showing how those studies line up with the deposit criteria. So we'll be talking about those today. And so we're going to be looking, as you said, at the criteria that you use when you're evaluating deposits for gold and silver companies. And where we're going to start is with some of the general things that you want to see kind of at all stages, from the smaller companies right up until the big ones. So we'll start with that broad umbrella there and learn what characteristics that you are looking for.
Okay. Well, there's really 4 that I would consider as the primary ones that apply all the way across the board. The first one, of course, is management. And that's a really big thing, as every investor would realize. But I see management in different ways for the different stages. Production being the final stage, the development is another stage, and the exploration on the third stage, the beginning one. The producers, I like to see CEOs that have been worked up through the ranks, that know how to build a mine and how to operate a mine. What that also means that I don't want to see lawyers and accountants doing that. And the reason is that in order to be a good manager at a mine, you need to have done a lot of the things that you have hired other people to do. And if you're a lawyer and accountant, you're not going to know the same things or be able to evaluate their performance. So I think it's really important that you have a CEO. So that's my preference when I look at a mining company. In the developers, then that's a very challenging level, because the CEO of a developer needs to actually have more skills than either of the other two. And that's because they're having to be involved with raising money. They're going to have to be involved with hiring people. They're going to have to evaluate a whole lot of different things, and so that they can take the process through to where they're ready to actually try to build a mine. And so that I wouldn't say necessarily you wouldn't want to have a lawyer and accountant, and there are a few very, very outstanding CEOs who have done all of those things. So I don't want to, but that's for my personal preference. The developer management is probably the most important, which is why I'd like to go to things like PDAC or the Vancouver Resource Investment Conference and actually meet the CEOs and talk to them. And for me, that gives me a greater confidence when I can ask them what I consider to be the crucial questions, like, okay, what do you see as the biggest problem? For example, tell me about that, and see what kind of an answer I get. So the management there at the developer level is really critical. At the exploration level is a different kind of thing, because the exploration CEO needs to have, first of all, be able to raise money, because if they don't have any, they can't drill holes. But they also have to have the skill to hire exploration geologists who are going to go out and actually find it, which is why they want to be able to hire people like that who've done it before. So that's my issues about management, but it's, of course, critical. And so take a close look at that. Then the next one is the ownership. I like to see ownership that's significant in the management team. In the beginning, say with explorations, I like to see at least 20%, maybe more, because you want to have skin in the game. Because the real weakness, especially in exploration, is that they dilute you to oblivion. you want them to not be diluting you. And if they have ownership, then they're not going to want to dilute themselves. So it's really important in that respect. The other issue that I like to see is that the outside investors, that there are some of them who have very strong financial positions and reputations. I mean, through the ideal, of course, is if you had Eric Sprott and Rick Rule and people like that, you know what I mean. If they're seen as being investors, then, okay, that Rick Rule has probably done a lot more research than I was ever going to do. And if he likes it, so I'd like to see that. Doesn't happen all the time, but it's something to look for. Who are the outside investors who are like you, then going to have done the research, and so it adds credibility to that. Then the other one is location. And location is an enormous issue because you want it to have the location to have political stability, taxes, safety, a rule of law, infrastructure, labor availability, weather, relationship with the locals, permitting issues. All of those things are wrapped up in the location. And of course, in terms of the producers, that's not so much because, of course, with producers, you've reduced the risk. Most of the risks are taken care of. The risk de-riskers is the developers. But the one thing that I would say in producers is that most of them are going to have multiple mines in different locations. And I like the ones, if I was going to invest in them, where they are in countries, for example, one like Agnico Eagle. Their mines are in Canada and Australia, maybe Mexico. There are none in other places like particularly Africa, which right now is having big problems. There's some wonderful gold deposits in West Africa, but there's also been coup d'etats in Mali and Burkina Faso and Niger within the recent months. And that I don't want to be involved with that. There's too many things that could go wrong in those kinds of situations. So anyway, so location is big, and I'll talk about further as we go through the other stages. But in terms of the producers, it's really just don't be in places that you have a lot of potential risks involved. Then the last one is the financial status. And the producers, I'd like to see them have little or no debt and to pay a dividend. That tells you that they're real solid. And there are many of the larger producers now who are paying a good dividend, 3, 4, 5%, which is very healthy. And, some investors may find that extremely attractive. They don't have the share price appreciation there. But on the other hand, there's less risk, and having a dividend that you can rely on is very nice because you're not going to get a dividend from a developer or an explorer. They're all needing money, not sharing it. So that's something else to think about.
So that was an overview of the factors that investors should look at for every level of mining company, from producers to developers down to exploration. Now, I know you have a list of things that you should look for specifically in each of those categories. So let's start with producers and then work our way down to developers and exploration companies, looking at the factors that you would consider for those specific categories of companies.
Okay. So then in terms of what are we looking for in producers when we evaluate them, and I can start with that in terms of looking at their websites, and all these companies have very good websites. So all of you investors, if you don't figure it out already, every gold mining company, explorer, at all levels, has a good website and a corporate presentation. And you want to click on the corporate presentation and read their story. And that's how they communicate with us. And so you want to make a habit of, the first thing, if you're listening to any kind of company, you want to go there and check that out. And they will tell the whole story, because that's how their investor relations department is knowing that they're marketing the company to you, the investor. So the thing I look at in looking at the producers is what is their current production and their growth forecast for production. And some of them aren't going to have that much production forecast. Some of the other ones will. I'd like to see if they're going to have growth, that it's internal growth. A lot of times, if they grow by mergers and acquisitions, which sometimes that works out well, other times they overpay, and there's issues with that. So you want to be, if they're going to grow acquisition-wise, then you need to talk to the management about how are you evaluating these things, because sometimes they pay way too much. That happened in the previous cycle, where there was a lot of big mining companies that paid way too much for not such great projects. And then when the downturn came, they were really hurting because of it. And so that's one of the issues in terms of outside investors who aren't invested in gold mining say, well, look what happened with the industry before. So the current reality is that the big producers now are very much more careful about their investments than they used to be back 15 years ago. So anyway, that's one thing. The other thing is to look at what's the current cost of production and the forecast of that cost. I'd like to see the producers, if I'm investing in the producers, to be below average in their cost, all-in sustaining cost, AISC. And $1,200 an ounce for gold is roughly the average. And so I'd like to see it be below that whenever possible. That gives me more confidence. And the other thing, of course, as I mentioned, is the financial strength, is that they have no debt and they pay dividend. So that's the producers. Then in looking at the developers, there's a lot more things that they need to be evaluating. The first thing is that the PEA has been completed, and then you consider them developers because they've got something to develop. And so then you want to look at all the details that the PEA has, and the PEAs will be on the websites. And so you want to read them very carefully. It's going to tell you what their projection is for how much they're going to produce, what the all-in sustaining cost is going to be, what kind of mine is going to be, open pit, or underground, and the mining methods and the processing methods, and all of those details. And so you want to read those very, very carefully. And then, of course, the management issue, you want, hopefully, this isn't always going to happen, but ideally, you would want to have a management team that had done the same thing they're trying to do this time before successfully. And the absolute holy grail is if they've done it in the same country. And you don't find that very often, but when you do, where someone has built a mine in the same country in the past, you want to give a lot of weight to that, because you're removing a lot of risks automatically when you're getting a management team, because then they know all the things that can go wrong because they've been there before. Permitting being one of the big ones, because so they know who you have to deal with and how you have to do it and so forth. Preferably, they even can speak the local language, which is ideal if you're in Latin America and South America, if you can speak Spanish and have a staff that does. All that is all positive. Then the other thing that I like to do is calculate the initial CapEx and it divided by the annual production. And I like to see that calculation come out at under $1,500. I mean, for example, what we're doing is saying if the CapEx was $150 million and the company was going to produce 100,000 ounces a year, then if you divide that, you'd get 1,500. And I'd like to see it at that level or lower. If it's higher than that, then the potential investor wants to ask a lot more questions. Why is it that high? Because and this is primarily for open pit, which is what most of these mines are. For underground, that's another deal. It's going to cost more money, and you need to dig in to that. And that's another. I won't take time to talk about all of those issues. It's too complicated. But most of the mines that I look at, and because I prefer open pits, because they have less risks and they have less capital expenditures, you have to drill fewer holes because they're closer to surface, and they don't have to drill as many because gold tends to be relatively well dispersed. Whereas with underground, they're much deeper and the veins are narrow. And so then how do you know how much you got down there? So it's another whole story, which is why I prefer open pit. And we won't get into that, but it costs more in many respects. Now, this would mean there's some great underground projects. They're notorious, very, very high grade, but they have to be high grade because there's so much more involved and so many more problems. Okay, the other thing that I like to look at is the depths of the deposit compared to the grade of the ore that they're talking about. I'm not going to go into that because it's a very complex situation, but you need to be recognized that the deeper it is, the more dirt you have to remove, and it just gets more expensive. So then you have all these issues regarding that, and because then it takes a lot of money to remove the dirt. So with the open pit project, the more dirt you're removing, and it gets more expensive. And so there's a criteria that they calculate called the strip ratio. And basically what that says is it's how many tons of overburden you have to remove for each ton of ore that you get that you can process. That's what the strip ratio says. And the company that's going to be developing an open pit project is going to tell you that. And of course, what you like to see is like a 1-to-1, where you got 1 ton overburden, but you get 1 ton out. If it gets bigger and bigger number, then you got to start looking at, well, wait a minute, how's it? It gets too deep. And there's some interesting situations where some developers of open pit say, well, yeah, but I got, the gold, but the drill results show that it's 100 meters or 200 meters deep. Well, maybe that's okay, provided as you work down to that, you actually can make some money on the way. So that's a very complicated issue. I won't go there, but investors need to look at that because there's a lot of potential glitches that can come aboard, and we're going to spend a whole meeting on that one. Okay, the other one is the initial capex divided by the market cap of the company, and I like to see that ratio be less than 3. In fact, significantly less than 3, because it's hard for a company that has a $100 billion market cap to raise $300 billion or $400 million to do a project, especially when it's an open pit project. I mean, and there's quite a range that you can find. My favorite company that I have a big position in, their market cap, CapEx to market cap is well under 1. I'd like that because then you don't have to dilute the shareholders to raise all this money to do that. And so you want to look at that carefully. And certainly that varies also depending on the condition in the gold market. If gold prices are going up and everybody's really rocking and rolling, then it'd be easier for a developer to raise $300 or $400 million for that kind of project. But right now, especially, no way. It ain't, because as you know, the market isn't very good right now. And the valuations of the developers and the explorers are not good. And my portfolio's down. So that's the issue that you need to be careful about. If to say that you got a developer and say, gee, I got a great project, but I need to raise this much money. And you say, well, probably not. The only way that would become a mine today is if it was acquired by a big producer who then had the money. And a lot of times that's what happens with a lot of exploration projects, particularly, or even some that are down the road with development, but they realize that they're never going to raise the money without diluting the shareholders to the point where it doesn't work. So they'd be better off to sell it off, which is what happens. So anyway, so we get to that. Then the other thing, 2 more, is the permitting. And that one, you really want to have a developer that has staff that knows how to do permitting, because that I have seen permitting squash more projects. And it can be environmental stuff. It can be political stuff. It can be that the locals don't like it, don't want to have a mine in their neighborhood. So you really want to get some sense for, okay, wherever this project is, what are the permitting issues? And it's the developers that are the ones that are going to be doing that. and then making that all work. And then there was the one other thing that the developer should provide you, the investor, with, and that's a timeline. The timeline that tells you when the pre-visibility study is going to be completed, when are they going to get the permits, when are they going to obtain the financing, when are they going to construct the mine, when are they going to be in production. They should show a timeline so that you can see how long is that going to take. Is it going to be a year and a half, 2 years, 2.5 years? You like to know that as an investor, because if the longer it takes for them to get into production, the more often they're going to have to raise more money, which means you're going to get diluted. So the timeline is a big deal. So you want to have a sense for that as soon as you can when you're investing in developers. So then we go to the explorers. And of course, I've mentioned about the management and the fact I like to see them have a skin in the game, and the outside investors, especially if you have good outside investors when they need to raise money, that there's probably going to provide it. Whereas if they have to go totally to the public every time, you're probably not going to have as easy time of raising money. And with the explorers, raising money is the whole deal. There's no revenue and there's nothing. So that's a critical matter that you want to have some sense for. Then let's see. Well, the other thing is, when are they going to need to raise more money, and how much, and from whom? And so if you're investing in explorers, you want to talk to them about that. Okay, where is it coming from? How have you been getting your financing? And because the thing that happens to most explorers is they run out of money, and they haven't found enough from drilling to justify investors putting more into it, so it goes away. And that happens all too frequently, unfortunately. So then, let's see, what else are we looking at? Yeah, the other thing about the management of the explorers is that they actually hire exploration geologists who have found deposits before. Then you say, well, maybe then they have credibility. And so you want to ask about that. Have these guys that you hired, have they found something before? Do they really know what they're doing? And then let's see. And then ask them, when is the PEA going to be finished? When are you planning to do that? That gives me some sense for how long I'm going to be invested in this company before there's some good news that tells the market that they really have something that can be a mine. Oh, another one that I like to focus is do they have a lab that they work with that is going to promptly give them drill results? I've seen some exploration companies I've invested in, and there go months and months and say, well, why there's no results? Why don't we know their lab is all backed up. Well, no, that doesn't, the exploration companies should have a good lab so that the results are turned around that indicates what the drill results were, because you spent the money, you want to get that into the market, particularly if the drill results are good. And so then the stock price goes up. So that's another issue that when I first got into this deal, I never thought it would matter, but it does. You want to get the lab results. And let's see. Oh, and is the project in an area where there's existing gold producers? That's nice, because those are potential acquirers. And that's always a plus, that you say, oh, well, yeah, maybe they don't, this team that they explore, they find it, but they're not developers anyway, so they're going to probably want to sell it. And if there are other producers in the neighborhood, they're going to find it that's beneficial for them to get another project that isn't a long way. So they can, same management team, can then manage both of those projects. So it's good for the producer, it's good for the explorer. So sometimes you find that, and if you do, you want to check that off as being a plus. And then, of course, there's the infrastructure availability and labor availability. A lot of times you're going to find these exploration projects, but they're off in the boondocks someplace. And so then you got problems with getting supplies and labor in there. Is there electricity and all these other water, all the infrastructure, the road, and and so you want to have a good sense. If you've got a project where the infrastructure is all really good, as well as the fact that it's not so far away that you have labor problems. And that's all, and especially where there's an area where there's other mines, then there's actually people who have experience working in mines. And so the labor availability is also something that I like to look at, say, what is that? How does that stand? So that if this thing's going to become a mine, obviously you got to have people, particularly ones who have some experience. So let's see if what else I have here. Yeah, I think that's pretty much covers most of what I was going to offer.
That was a very thorough list. I like how you broke it down between things that we need to look at for all types of mining companies and then going through producers, developers, and exploration companies. I have one follow-up question. So you mentioned that, of course, you like to go to events like BRIC and PDAC to talk to company executives. But a lot of this information you should be able to find on a company's website. So I wonder for you, if you are going to a company's website and you're having trouble finding answers to your questions, is that a red flag for you? How do you feel about that?
Yeah, well, I do tend to evaluate the quality of the website. If the website is good, if it's kept up to date, if I get to go to one website and it hasn't been updated in 6 months, I'm like, what? And then the data, when I look at the data and the data on page 3 doesn't match with the data on page 8, then wait a minute. So I call the investor relations department, by the way. They always provide a contact at the end of the website. And frequently I will call the IR, investor relations person, and say, did you know that, page 3 doesn't agree with page 8 or you haven't updated it? Why is that? What's going on here? So yeah, I think if the company is really on top of things, the website should be very well done. And if you've seen, since you're looking at various companies, you're going to see a variety of websites. You'll begin to get an idea of what's a good one. Are they answering all your questions? Do they answer them correctly? Or is it a lot of mumbo jumbo? So this is important. If they can't tell their story very well, or they don't keep the information in front of the investor on a current basis and all that, then that's a red flag. Absolutely. The other thing, though, I'd like to go to the conferences and meet the management, because I really want to invest my money with people that I think I might want to invite to dinner. I want to have a good feeling about them. I mean, I'm a people person, and so I like to feel that they're going to answer my questions directly. They're going to make an effort to help me understand something that I'm trying to get some understanding of, and it just helps me a lot. And there's also the body language of the people in the booth. I mean, I notice those things.
Yeah.
And when I see where there's some employee in the booth that's sitting there listening to the CEO talk to me, and the look on his face is, oh, he's telling him that one again, kind of thing. You pick up a lot that way. And I've been going to these things for 20 years. I started going to the Vancouver Resource Investment Conference, at least 20 years ago, long time. And I'm very much looking forward to going to this next one. But I hope that I can see you there, by the way.
We will definitely be there at VRIC this coming January. So I really do hope that I see you there. For now, this is a really great conversation. I think it'll be very useful to our audience. And just a note for everybody out there, if you do have questions for Don or topics that you'd like to see him cover, leave us a note in the comments and we will try to take that on. Once again, I'm Charlotte McLeod with investnews.com, and this is Don Hansen. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.